Welcome to Wall Street Weekly.
It is great to be here. We have a lot to unpack.
We really do. It's a funny thing about complex machinery. I want you, listening right now, to imagine standing in the middle of this massive, roaring factory floor.
Right.
There's this giant engine right in the center, and it's been running at absolute redline for months. I mean, it's hot to the touch, it's vibrating the concrete under your feet, and it sounds like it's about to just, tear itself apart at any second.
A terrifying sound if you don't know what you're looking at.
Exactly. To anyone walking in off the street, it's terrifying. But then you watch the mechanics in the room. The engine suddenly drops a few thousand RPMs. It sputters just a tiny bit, losing that really high-pitched scream.
And the casual observer thinks the factory is breaking down.
Right. Oh no, we're failing. But the mechanics, they look at each other, let out this massive sigh of relief, and actually start cheering.
Because the mechanics understand structural limits. I mean, they know that if that engine didn't slow down right then, the friction was going to literally melt the entire assembly line into a puddle of slag.
Yeah, they were actively praying for that exact deceleration, just so the machine could actually survive the rest of the year.
And that's just a perfect mental image for what we are unpacking in this deep dive today.
It really is. We are looking back at a truly chaotic, holiday-abbreviated trading week. Specifically, we're spanning June 29th to July 3rd, 2026.
Which was just an incredibly compressed turn-of-the-month stretch. The sheer density of market-shifting news was, well, it was staggering.
Yeah, we're talking about a massive corporate spinoff that is fundamentally altering the media landscape. We've got wild, unprecedented 10% swings in global tech sectors across Asia.
And of course, a U.S. labor market that suddenly showed us exactly what that sputtering factory engine actually sounds like.
Right. And to make sense of this, we've pulled together an incredible stack of sources for you. We are diving into institutional market summaries. We're tracking data across the Bloomberg commodity complex, breaking down the massive divergence in the Russell indices.
We also have some really in-depth research notes from J.P. Morgan and Fidelity.
Yeah, and we're analyzing the raw macroeconomic prints from the U.S. Labor Department and the ISM, because the mission here isn't just to, recap the numbers for you. We want to extract the underlying signal from all this deafening noise.
So that you have a comprehensive strategic framework for the week ahead from July 6th through the 10th.
Exactly, because surface-level numbers can be incredibly deceptive right now, can't they?
Oh, absolutely. I mean, if you just look at the headline that the Dow Jones hit a record high, you completely miss the violent internal tug-of-war happening right beneath the surface.
Yeah.
It was a week where deteriorating economic data became the exact lifeline the financial markets needed to stay afloat.
It's that bad news is good news dynamic. So let's get right into the mechanics of that, starting with how the week opened. We came into Monday limping off a pretty punishing 5-day losing streak.
Right. The narrative of the prior week was completely dominated by this intense anxiety over artificial intelligence valuations.
This creeping fear that tech had simply flown too close to the sun, basically. But Monday opens, and instead of a continued sell-off, we see this broad, really aggressive recovery.
Yeah, the Dow Jones eventually secured its best weekly gain in 2 months, surging 1.37% to close at a record 52,900.07 by Thursday.
Record highs. But the initial spark for this reversal, it didn't come from a Silicon Valley startup. It actually came from a legacy giant, Comcast.
Right, Comcast, trading under CMCSA, they dropped this structural bombshell on Monday morning that effectively shifted the center of gravity for the entire communications services sector.
What exactly did they do?
They announced a massive reorganization. They are formally initiating the spinoff of their NBC Universal Media business and the Sky Network. Yeah, they are cleaving those legacy entertainment assets completely away from their core broadband and wireless infrastructure business.
I found the market reaction to this fascinating, honestly, because Wall Street absolutely loved it. Shares surged 6.7% right out of the gate.
They did.
But NBC Universal is a legendary crown jewel media property. I mean, it includes massive movie studios, theme parks, cable networks. Why on earth does the market cheer when a company decides to chop off the most famous, glamorous part of its identity?
Well, it all comes down to how institutional capital prices different types of revenue. It creates what we call a conglomerate discount.
Okay, break that down for us.
So for years, Comcast has been trying to balance two fundamentally incompatible business models under a single corporate umbrella. Let's look at the broadband and wireless infrastructure side first.
The cables in the ground.
Exactly. That is a high-growth, high-margin, utility-like business. It generates incredibly steady, predictable cash flow, because, consumers pay their internet and wireless bills with the same priority as their water or electricity.
It's completely essential. You can predict those subscription revenues years in advance with a really high degree of certainty.
Precisely. Now compare that to legacy digital entertainment broadcast networks and movie studios.
The NBC side.
Right. That business is inherently chaotic. It is heavily capital intensive. It's cyclical, and it requires constantly fighting this brutal, incredibly expensive war for consumer attention against streaming giants like Netflix and YouTube.
Right.
You might spend, say, $300 million on a blockbuster film that completely flops at the box office and that wipes out a whole quarter's worth of profits.
It's basically trying to run a highly predictable municipal water utility while simultaneously running a Las Vegas casino out of the exact same headquarters.
That is exactly how portfolio managers see it, and they hate that structural friction.
Yeah, I bet.
If a pension fund manager wants to invest in staple telecom infrastructure for reliable dividends, they do not want the risk of a box office bomb or a Hollywood writer's strike dragging down their quarterly returns.
So by slicing the high-growth telecom assets away from the legacy media assets, Comcast executed a textbook value-unlocking maneuver.
Yes. They are forcing the market to price the broadband business purely on its own merits, completely unburdened by the media anchor.
So they are finally giving investors a pure play option. Like, you want telecom, buy the new Comcast. You want media chaos, buy the spinoff.
Exactly. And that clarity explains why the broader communication services sector caught a massive bid, finishing the week up 1.59%. It wasn't just about one company. It was a signal that corporate boards are actually willing to unlock trapped value.
That makes total sense. But while U.S. legacy tech was reorganizing on Monday, we got an announcement out of South Korea that genuinely broke my brain regarding the scale of capital expenditure.
Yes, the AI hub.
Right. Samsung Electronics and SK Hynix announced a joint commitment to build an artificial intelligence semiconductor manufacturing hub, and the price tag, $518 billion.
$500 billion dedicated to physical infrastructure.
I mean, that's insane.
It is. Backed heavily by the South Korean presidency, this is not just corporate strategy anymore. This is a sovereign-level maneuver.
Wow.
South Korea is attempting to permanently secure its dominance in the global AI hardware supply chain. They see the writing on the wall regarding the insatiable enterprise demand for high-bandwidth memory chips, and they are moving really aggressively to ensure they control that manufacturing choke point.
Wait, this is where things just don't add up for me. We've spent the last month hearing financial pundits scream about an AI valuation bubble.
Right, the hype narrative.
Yeah, the dominant media narrative is that stock prices for anything AI-related have run too far, too fast, and it's all just speculative hype. But $500 billion? That's an incomprehensible amount of physical hard money.
It is.
They are pouring millions of tons of concrete. They're building massive clean rooms, buying ultra-expensive lithography machines. If these legacy tech giants are investing that much into the tangible, physical reality of AI, how can anyone dismiss this as a speculative bubble? Because that sounds like the most grounded, real-world growth imaginable.
Right. But the skepticism isn't really about whether artificial intelligence is a real technological revolution. No one is doubting that.
Okay, then what's the fear?
The anxiety centers entirely on the timeline of the return on investment. It's what we call the duration mismatch.
A duration mismatch.
Yeah, yes. Pouring concrete and installing lithography machines from suppliers like Applied Materials, who, by the way, saw their stock surge 11.5% on this news that is very tangible.
Right.
But a $518 billion facility does not generate revenue tomorrow. It takes 3 to 5 years to build, equip, test, and bring to full commercial yield.
And Wall Street does not have a 3 to 5 year attention span.
Wall Street operates on strict 90-day quarterly cycles.
Yeah.
When you have hundreds of billions of dollars tied up in enterprise capital expenditures, or CapEx, portfolio managers get incredibly nervous about the valley of death.
The valley of death.
That's the vast expanse of time between spending the billions to build the data center and actually seeing a realized profit margin from the software services running on those chips.
I see.
Investors are looking at the massive stock prices of these companies and asking, can they generate enough near-term cash flow to justify their valuations while we wait half a decade for these superhubs to even come online?
So the physical reality of building the future takes 5 years, but the financial market demands the profits in 5 months.
Exactly.
That duration mismatch was clearly bubbling under the surface all week, even as the major indices were busy celebrating the end of the quarter.
Tuesday marked the close of Q2.
Yeah, and remarkably, despite all the anxiety over AI timelines and tech volatility in June, the S&P 500 locked in its strongest quarterly performance in 6 years.
Dating back to 2020, which
Yeah.
is just a massive testament to the sheer momentum of U.S. mega-cap equities.
We haven't seen a quarter like that since the post-pandemic rebound. But there was a much darker shadow hanging over Tuesday's session, wasn't there? One that highlights severe fractures in the global macroeconomic landscape.
You're talking about the yen.
Yes, the Japanese yen suffered a catastrophic drop, plummeting to a 40-year low against the US dollar. Now, for anyone tuning into this whose primary focus is just, their US 401k.
Right, domestic investors.
Yeah, a currency fluctuation in Asia might not seem relevant at all. But when a G7 currency hits a 40-year low, it feels like a massive flashing red light on the global dashboard. Why is the yen collapsing, and why does it matter to a U.S. investor?
It matters deeply because it traces directly back to the Federal Reserve and the policies of Fed Chair Kevin Warsh.
Okay, how so?
The U.S. has been operating in a highly restrictive, higher-for-longer interest rate environment. Warsh has made it abundantly clear that he will not pivot until underlying inflation is dead and buried. As a result, U.S. Treasury yields have remained very attractive. On the opposite side of the globe, though, the Bank of Japan has maintained a fundamentally different, ultra-loose monetary policy.
Meaning they're keeping their interest rates essentially near zero to stimulate their own economy.
Exactly. So if you're a massive global hedge fund,
I can borrow money in Japan for practically nothing, convert it to US dollars, and park it in treasuries to collect a risk-free 5% yield.
the classic carry trade.
Wow.
Because capital is inherently lazy. It flows to the path of least resistance and highest yield. If you can get a premium yield in U.S. government bonds safely, keeping your money in Japanese yen yielding near zero makes absolutely no fiduciary sense.
So institutional capital aggressively exits the yen and buys dollars.
Yes, and this massive capital flight sucks liquidity out of Japan and crashes the valuation of their currency.
Now, I did see that the Nikkei 225, that's Tokyo's stock index, actually got a 0.9% boost on Tuesday. I assume that's because a weak yen makes Japanese exports like cars and electronics incredibly cheap and competitive on the global market.
It does. It provides a short-term sugar high for Japanese exporters, absolutely. But from a systemic standpoint, stretching the interest rate gap between the U.S. and Japan to this extreme creates immense tension.
Just can't last forever.
You can stretch that rubber band for a while, but eventually, either the Bank of Japan has to intervene aggressively to save their currency, or something in the global financial plumbing snaps.
And that tension perfectly sets the stage for what happened midweek. Just as global markets were wrestling with these massive macro forces and currency strains, the U.S. economy dropped a series of data points that completely shifted the narrative.
The macroeconomic squeeze.
Exactly. This is where that factory engine analogy from the beginning of our deep dive really comes to life.
Right, because the market was completely desperate for proof that the U.S. economy was finally cooling down.
They needed proof that would force Kevin Warsh's hand and give him the political and economic cover to pause those restrictive high interest rates that were wrecking the yen and squeezing corporate margins.
And the first piece of evidence arrived on Wednesday with the ISM manufacturing PMI.
Right, the PMI. This is essentially a survey of purchasing managers, the people who buy the raw materials for factories.
Correct. The headline index dipped to 53.3% from 54.0% in May. But the number that caused jaws to drop was the sub-index for prices paid.
Yeah, it plummeted from 82.1 down to 73.0 in a single month.
That drop in prices paid is the smoking gun for disinflation.
Really?
Yes. When purchasing managers report that the cost of raw materials and inputs is falling that rapidly, it indicates that the frantic pandemic-era supply chain bottlenecks have finally cleared. Factories just aren't bidding up the price of steel or microchips out of sheer desperation anymore.
As I was reading through the sources, one of the research notes used a fantastic mental model to explain this that really clicked for me.
The bakery analogy.
Yes, think of the U.S. manufacturing sector like a massive industrial bakery. The headline PMI score is just a thermometer measuring if the kitchen is baking more or fewer cupcakes than they did last month. Anything over 50% means they are expanding production. So at 53.3%, they are still growing.
Right.
But Lately, the bakers had been running around in an absolute panic. They were hoarding flour, they were double ordering sugar because of supply chain fears, working crazy overtime, and that panic drove the price of ingredients through the roof.
That was the 82.1 prices paid reading from May.
Exactly. But this week, the scorecard shows they've finally calmed down. They are still baking more cupcakes, but at a normal, sustainable pace. Because they aren't rush ordering ingredients out of panic, the price of that sprinkle sugar and flour plummeted. That's the drop to 73.0.
It illustrates the concept of disinflationary growth beautifully. The economy is still expanding, which prevents a recession, but the underlying cost of that expansion is dropping, which kills inflation.
And while that ISM data was encouraging, it was really just the appetizer, wasn't it?
Oh, absolutely. The main course, the true market-altering event, was served on Thursday morning with the U.S. Labor Department's highly anticipated June non-farm payrolls report.
This was the absolute bombshell of the week. Heading into Thursday, Wall Street consensus estimates were projecting the U.S. economy would add roughly 100,000 to 115,000 new jobs in June.
And the actual print.
A mere 57,000. It was a massive, jarring miss. And to make matters worse, they revised the data for April and May downward by a combined 74,000 jobs.
Which means the economic strength we thought we had in the spring was actually a mirage.
Yeah.
Adding only 57,000 jobs across the entire U.S. economy definitively proves that corporate hiring has hit a brick wall. When you combine the June miss with the negative revisions to prior months, the trend line is just undeniable. The slowdown has been quietly taking root for an entire quarter.
But this is where the data gets incredibly contradictory and why it breaks so many traditional economic models.
How so?
Hiring fell off a cliff, right, but the baseline unemployment rate only edged down slightly to 4.2%. Even more baffling, initial jobless claims, the number of people lining up to file for fresh unemployment benefits, actually dropped to 215,000.
Right.
How can hiring collapse without unemployment skyrocketing?
Because companies have adopted a strategy of labor hoarding.
Labor hoarding.
Yes. The drop in initial jobless claims tells us something vital. Businesses are not firing their existing employees. The scars from the post-pandemic labor shortage are still just too fresh.
They remember how hard it was to hire people.
Exactly. Executives remember how impossible it was to find good talent, so they are flat out refusing to authorize mass layoffs. They just aren't opening any new recs. They are freezing headcounts, halting expansion, and letting natural attrition shrink their workforce slowly.
The sources framed this with a brilliant analogy about a neighborhood game of tag.
I love this one.
Yeah. Imagine the U.S. labor market is this giant ongoing game. Historically, the neighborhood invites 100 new kids to join the game every single month to keep it growing.
Right.
This month, they only sent out 57 invitations. So the game is still growing. There are still more kids playing than last month, but the growth has decelerated massively.
And at the same time,
the kids who are already in the game aren't leaving. That represents the low jobless claims. It is incredibly difficult to get a new invitation to play right now, but if you're already on the field, your spot is completely safe.
And that dynamic is the absolute definition of the Goldilocks scenario for the Federal Reserve.
How so? Because it sounds miserable for anyone looking for a job right now.
It is tough for job seekers, absolutely. But from a macroeconomic perspective, it's perfect. The economy is cooling exactly enough to drain the inflationary pressure.
I see.
Without a frantic scramble to hire new workers, the wage price spiral breaks. Businesses don't have to keep jacking up starting salaries by 10% just to poach talent from their competitors. Wage inflation dies.
But crucially, because there are no mass layoffs, you avoid plunging the consumer economy into a deep, painful recession.
Precisely. People still have their paychecks, they just aren't getting massive raises.
So when Wall Street digests this bad news of a hiring collapse, they basically throw an absolute party.
The bond market reaction was historic. Fixed income investors interpreted the 57,000 payroll number as undeniable proof that wage-driven inflation is finally defeated.
So the yields plummeted.
Big time. The 10-year Treasury yield, which had been stubbornly high, plummeted to 4.47%. More importantly, the Fed funds futures market immediately priced in an 80% probability that Chair Warsh and the committee will officially halt their rate hike campaign at the upcoming meeting.
I really want to spend some time on the bond market mechanics here, specifically the yield curve, because the research notes highlighted this as a massive turning point. The 10-2 Treasury spread steepened by 27.55% on the week.
A huge move.
For anyone outside of a trading desk, yield curve steepening sounds like pure academic jargon. Let's build this from the ground up. How does a jobs report cause a 27% shift in a spread, and why does that drive the stock market to record highs?
Well, the yield curve is arguably the most important predictive signal in all of finance. It compares the interest rate the government pays you to borrow your money for 2 years versus 10 years.
Okay.
Under normal, healthy economic conditions, you should get paid a higher interest rate to lock your money up for 10 years, simply because you're taking on more duration risk and inflation risk.
Yeah.
The curve slopes upward.
Right. If I lend you money for a decade, a lot can go wrong. So I demand a higher premium than if I lend it to you for 24 months.
Exactly. But for a long time, this curve has been inverted. The 2-year yield was actually significantly higher than the 10-year yield.
Which feels backward.
It is. That inversion happens when the bond market believes the Federal Reserve is keeping short-term rates artificially punitively high to choke off inflation, even if that chokehold is guaranteed to damage long-term economic growth.
So the 2-year yield tracks the Fed's immediate policy, and the 10-year tracks the long-term health of the economy.
Precisely. Now, when that terrible 57K jobs report hit on Thursday, the market had an epiphany. The Fed doesn't need to keep choking the economy anymore.
The inflation war is largely won.
Right. So expectations for immediate short-term interest rates plummeted. The 2-year yield dropped like a stone, falling much faster than the 10-year yield. The gap between them widened or steepened, moving rapidly back toward a normal, uninverted state.
So the bond market is essentially front-running Kevin Warsh screaming, "We know you're done hiking, normalcy is returning."
Yes. And because the broader cost of capital, the discount rate used to value equities dropped, it provided the exact jet fuel that pushed the Dow Jones to a record 52,900.
It creates a massive relief rally for large, stable, dividend-paying companies.
It really does.
Okay, that paints a beautifully optimistic picture of blue-chip stocks and treasury bonds holding hands and walking into the sunset. But here's the massive contradiction that jumped out at me while reading the sector breakdowns.
Let's hear it.
If the broader market loved this cooling data so much, why did some very specific areas of the market get absolutely crushed? Let's look at the internal tug-of-war beneath the surface of these index records.
Yeah, if you lift the hood on the major indices and break the market down by capitalization size and GICS sectors,
Right.
the global industry classification standard, you see violent structural divergence.
The rising tide did not lift all boats.
Not at all.
Let's start with company size. The Russell 1000, which tracks the largest 1,000 companies in the U.S., gained 0.56% on the week as investors rotated into value stocks.
Right.
But the Russell 2000, which tracks smaller cap companies, actually lost 0.48%. Let me push back on the logic here. If interest rate relief is finally arriving, shouldn't the smallest, most vulnerable companies be celebrating the loudest? Why are they dropping?
It comes down to a vital, often misunderstood nuance between a Fed pause and a Fed cut.
Okay.
To look at the balance sheets, the mega-cap defensive giants in the Russell 1000, they locked in their long-term debt years ago when rates were at 2%. They are insulated.
Right, they don't care what the rate is today.
Exactly. Small-cap companies in the Russell 2000 do not have that luxury. They are highly leveraged, relying heavily on regional bank revolving credit facilities. Crucially, that debt is often floating rate debt tied directly to the current prime rate.
Wow. So every single month, rates stay high. These smaller companies are bleeding cash just to cover the interest payments on their loans.
Exactly. Now, when the 57K jobs report came out, the bond market signaled that the Fed will pause. They won't raise rates any higher, but a pause is not a cut.
A pause simply means rates are staying higher for longer at their current punishing altitude.
Right. The bleeding doesn't get worse, but the bleeding doesn't stop either.
The small caps didn't need a plateau. They desperately needed a parachute. They needed a signal of immediate, aggressive rate cuts just to survive their debt loads.
And when they realized they were only getting a pause, institutional desks heavily dumped small-cap risk exposures.
So the exact same macro data point that sends a mega-cap telecom stock to the moon acts as a lead weight tied to the ankle of a small-cap industrial firm.
Precisely. And we saw this same intense polarity in the sector breakdowns. Financials tracked by the XLF ETF were the absolute stars of the week, surging 3.54%.
Huge. Healthcare was up 1.87% too.
Yeah. But the mighty tech sector, the undisputed leader for the past year, was the biggest loser, dropping 2.60%.
I can see why healthcare caught a bid. It's a classic defensive safe haven. It offers reliable dividend yields when growth stocks get scary. But the massive surge in financials, does that tie directly back to the yield curve steepening we just broke down?
Is a one-to-one correlation.
Really?
Yeah, banks manufacture their profits out of the net interest spread. They borrow money at short-term rates, that's the minimal interest they pay you on your checking or savings account, and they lend that money out at long-term rates, like a 30-year mortgage or commercial real estate loan. When the yield curve is inverted, their profit margin is completely compressed. They're basically paying more to borrow than they are making on lending.
But the moment that curve started uninverting on Thursday,
The profitability models for every major bank balance sheet on Wall Street instantly turned green. Capital flooded into the financial sector, front-running their Q2 earnings reports, just anticipating that their core lending margins are about to expand dramatically.
which brings us to the tech sector getting hammered. But before we dive into the global tech route, I noticed a paradox in the volatility data that I think is essential to explore.
Let's do it.
We track three main metrics from the sources: the VIX, the MOVE Index, and the Shiller PE ratio. The VIX, commonly known as the stock market's fear gauge, plunged by 10.42% this week.
A massive drop.
And the MOVE Index, which measures fear and volatility in the bond market, dropped 4.02%. On paper, institutional investors are feeling incredibly safe. The fear is gone.
Right. Volatility expectations completely collapsed once the macro data seemingly guaranteed a Fed pause. The market felt it had removed the biggest unknown variable.
Right. But then you look at the Shiller PE ratio. For those unfamiliar, this metric measures long-term inflation-adjusted valuation multiples for the S&P 500. And despite this supposed economic slowdown, the Shiller PE actually expanded by 0.51% this week.
Crossing above a ratio of 41.
Exactly. That means investors are paying a multi-year, multi-decade premium for these stocks right now. If fear is at rock bottom, but the price of admission is at historic nosebleed highs, aren't we just whistling past the graveyard? Is this the definition of market complacency?
It raises a profoundly alarming question about systemic risk and margin of safety. The expansion of the Shiller PE proves mathematically that the market's upward momentum last week wasn't driven by companies suddenly generating more revenue or higher profits.
And what was it driven by?
It was driven entirely by multiple expansion.
Explain multiple expansion in this context.
It means investors are simply willing to pay more dollars today for the exact same dollar of corporate earnings tomorrow, purely because the macroeconomic discount rate dropped.
So the fundamental business didn't improve. The psychological willingness to overpay just increased.
Exactly. The danger is that when you combine rock-bottom volatility, meaning zero fear, with sky-high valuation multiples, your margin of safety drops to zero.
Everything is priced for absolute perfection.
And any unexpected shock to the system is magnified exponentially because there is no valuation cushion to absorb the blow.
And while U.S. domestic investors were feeling incredibly safe on Thursday, celebrating those Dow records and ignoring the Shiller PE, a literal financial earthquake was happening simultaneously across the Pacific.
Oh man, the Asian markets.
Which brings us to the global hardware route and the phenomenon our sources labeled the KOSPI casino. This is where the narrative gets truly wild. Thursday saw a violent synchronized tech sell-off globally, but the epicenter was squarely in South Korea. The KOSPI index plunged an astonishing 7.9% in a single trading session.
A near 8% drawdown for a sovereign benchmark index in a single day is staggering. It completely breaks normal statistical models.
It's unheard of.
That is the kind of massive volatility you associate with unforeseen black swan events, certain geopolitical wars, or global pandemics. You do not expect a major developed nation's stock market to crater 8% on a random Thursday in July just because of a U.S. jobs report.
The carnage was intensely focused on the exact memory chip giants we discussed earlier, Samsung and SK Hynix. The institutional anxiety over artificial intelligence capex just boiled over.
Right, the fear we mapped out that these massive $500 billion infrastructure investments won't translate to near-term profitability that sparked a brutal liquidation.
It was the AI duration mismatch weaponized by extreme market concentration.
Exactly.
But the volatility didn't stop there. On Friday, while U.S. markets were completely closed for the July 4th holiday and American traders were off at barbecues, the East Asian markets staged this massive rubber band snapback.
Oh, it was a massive whiplash.
Samsung rose 8.2%. SK Hynix jumped 10.9%. And there was this mid-tier Japanese electronic component supplier, Taiyo Yuden, that surged 22.5% in one day.
22.5%.
And their catalyst.
Right.
They simply tweaked their board compensation structure to incentivize long-term performance targets. A 22% jump on an administrative board tweak.
That kind of localized volatility, crashing 8% on Thursday, surging 10% on Friday, individual suppliers jumping 20% on corporate governance news, is deeply
Pathological.
Yes, it is not the sign of a healthy, price-discovering financial market. It requires us to look at the structural flaws of the South Korean exchange itself. If we dig into the historical data from the sources, the KOSPI index surged 91.46% over the preceding 6 months and an unbelievable 160% over the trailing year.
That is crypto-level growth for an entire national stock market.
Exactly. And that entire historic rally was built almost exclusively on the back of AI hardware hype surrounding just a handful of massive companies, primarily Samsung and SK Hynix. The index became a highly leveraged monoculture.
And when a national market becomes a monoculture, it transforms from an investment vehicle into a speculative casino.
It really does.
I want to push back on the dominant media narrative we saw echoed in some of the source notes. So much international financial news last week was screaming that U.S. artificial intelligence CapEx spending is reckless and is going to cause a global crash.
Right. American tech bubble threatens Asian stability.
Exactly. But isn't that totally backward? Look at the underlying fundamentals. The U.S. software giants buying these chips, Microsoft, Alphabet, Amazon, they are showing incredibly solid cash flows. They have fortress balance sheets. Yes, they're spending billions on chips, but they can afford it.
It's true.
It's not the U.S. software sector that's sick. It's the Korean hardware market that has decided to treat its sovereign index like a leveraged roulette wheel. One of the research notes used a brilliant medical analogy for this.
I know the exact analogy you're referring to, and it perfectly frames the systemic risk.
Right. If a patient catches a severe cold every single week, you don't just hand them a tissue, blame the weather, and ignore it. You have to treat the underlying immune system.
Yes.
The weekly 8 to 10% drawdowns are the cold. The immune system is the structural integrity of the KOSPI exchange. And right now, that immune system is deeply compromised by speculative leverage. If local regulators in Asia dismiss these massive sell-offs as just quirky tech jitters, what is the ultimate downside risk?
The risk is triggering a catastrophic liquidity trap. We have to look at who actually funds these markets.
Okay, well.
The baseline capital for the KOSPI comes from massive foreign institutional investors, global pension funds, sovereign wealth funds, giant asset managers. These entities demand structural stability. They are tasked with faithfully compounding wealth over decades.
Right, they aren't day trading meme stocks.
Exactly. They cannot operate in an environment where their core assets lose 10% on a Thursday and randomly gain it back on a Friday.
The volatility itself violates their risk mandates.
Precisely. If these foreign institutions look at the KOSPI and decide that it has permanently chosen to be a high-leverage speculation vehicle rather than a profit-driven, fundamentally sound market, they will simply pack up their capital and withdraw it.
Wow.
And they won't come back. If that foreign capital flees, the liquidity pool dries up entirely. When liquidity dries up, you can't sell shares without tanking the price even further because there are no buyers on the other side of the trade.
So it wouldn't just be a cold for the patient. The entire capital framework supporting Asia's tech manufacturing boom could collapse.
It would bring a disastrous, grinding halt to the region's historic market run.
That is a staggering divergence. While the U.S. is popping champagne over a Goldilocks economic slowdown with utility-like blue chips hitting records, the hardware manufacturers building the very physical infrastructure of the AI revolution are operating on a financial fault line that could crack at any moment.
It really proves that you cannot just buy a passive global index fund, go to sleep, and assume you are completely diversified.
No, you have to understand the specific structural mechanics of exactly where your money resides.
And speaking of physical infrastructure and structural mechanics, this provides a pretty seamless transition from the silicon and software of the tech world to the literal dirt, metal, and fuel of the physical world.
Oh, the commodities market.
Yes. Let's examine how raw materials were reacting to this massive macroeconomic tug of war, because the commodity complex saw a fascinating return to supply normalization last week.
It did. The broad commodity market finally caught its breath after a very rough month. We saw the broad Bloomberg Commodity Index, the BCM, stabilize, finishing up 0.41%.
Which comes after weeks of steep liquidations where hedge funds were dumping commodities based on those fears that Kevin Warsh's high interest rates were going to trigger a global recession and just kill raw material demand.
That stabilization was hard-fought, but when you break down the subsectors, you see incredibly distinct narratives driving different materials. Agriculture, for instance, surged 2.81% on the week.
A lot of that upward pressure was driven by shifting summer weather grids threatening crop yields in the Midwest.
Right.
And that was combined with portfolio managers executing mandatory mid-year index rebalancing targets, forcing them to buy ag futures to meet their allocation quotas.
We also saw precious metals jump 2.36%, and that connects directly back to that Thursday morning bond rally we discussed earlier.
It is a textbook macroeconomic reaction. Gold and silver are non-yielding assets. They don't pay you a dividend or a coupon.
So they constantly compete against U.S. Treasuries for capital.
Exactly. When the 57K jobs report caused Treasury yields to plummet, the opportunity cost of holding gold dropped instantly. That stark triggered massive short covering by traders who had bet against precious metals, driving the price up violently.
But the real structural story, and the one that impacts every single person listening to this, was the massive divergence within the energy complex.
Energy was fascinating this week.
Energy as a whole was the major laggard of the week. Brent and WTI crude oil fell significantly. Brent was down 1.41% and WTI dropped nearly 3%. But at the exact same time, Henry Hub natural gas gained almost 2%.
Right.
Why are two major fossil fuels moving in completely opposite directions during the exact same economic window?
It comes down to global maritime logistics versus highly localized domestic demand grids. Let's examine crude oil first.
Okay.
Oil is an entirely globalized waterborne commodity. Its price is heavily dictated by the free flow of international shipping lanes. Throughout the week, maritime tracking intelligence verified that commercial supertankers were moving smoothly through the Strait of Hormuz and other key global choke points without incident.
So all that geopolitical anxiety that usually spikes the price of oil just evaporated.
Exactly. We refer to that as the geopolitical war premium. For months, the options market had baked a massive premium into the price of crude, assuming an imminent supply disruption in the Middle East.
But because back-channel diplomacy and structural sanction waivers have kept the waterborne energy corridors flowing smoothly, that premium completely deflated.
Yes. There is a comfortable, steady influx of physical oil hitting the global trade lanes. It is so robust that it completely neutralized any localized midweek data showing drops in U.S. commercial inventories. Oil is dropping simply because the seas are calm and the tankers are sailing.
But natural gas is a completely different beast, isn't it? You can't just put it on a standard tanker.
Right. It is entirely decoupled from global crude dynamics. Unless you spend billions to liquefy it into LNG, natural gas is a heavy, difficult-to-transport domestic commodity. It trades almost purely on localized U.S. fundamentals.
And last week, weather models heading into the July 4th weekend shifted dramatically.
Meteorologists projected massive, scorching summer heat waves settling across key U.S. population centers and manufacturing belts.
And when it gets that hot across the entire country, every single home and office building cranks the air conditioning simultaneously.
And how do we generate the massive baseload electricity required to power that air conditioning? Massive gas-fired power plants.
So the market anticipated this massive surge in demand for the electrical grids,
which effectively tightened the immediate spot delivery markets for natural gas, driving the price up 2%. So while crude oil traders are monitoring global supertankers navigating the Middle East, natural gas traders are obsessively monitoring the thermostat in Chicago and Atlanta.
Think about what this means for your own wallet. If you're listening to this and wondering why your monthly budget feels slightly less squeezed, or why consumer confidence indexes show this weird mix of anxiety about job hunting but optimism about the next few months, this energy divergence is exactly why.
It makes a huge difference.
The massive energy shock that dominated the last 2 years is deflating. Global oil prices dropping acts as a massive stealth tax cut for everyday consumers right in time for summer road trips. Even if falling crude hurts the energy sector equities sitting in your retirement account, it actively puts $20 or $30 extra in your pocket at the gas pump every single week.
It provides a vital economic buffer for the consumer, which is desperately needed given the slowing job growth we unpacked in that 57K payroll report. That cheap gasoline might be the exact mechanism that keeps retail spending afloat and prevents a recession this summer.
Okay, we've thoroughly mapped out the chaotic terrain of the past week. We understand the corporate spin-offs unlocking value, the Goldilocks macro data steepening the yield curve, the structural fragility of the Asian tech casino, and the commodity normalization putting money back in consumers' pockets.
A lot of ground covered.
Let's shift our gaze to the windshield. What is the playbook for the week ahead, July 6th through July 10th? What data points do we need to prepare for?
We are entering a crucial transitional window for the market. The narrative is shifting away from the macro labor data we just digested and pivoting toward core service sector metrics, monetary policy nuances, and the very first previews of corporate earnings.
Monday, July 6th, hits us immediately with the S&P Global Services PMI and the ISM Non-Manufacturing PMI. We talked extensively about the factory-bakery analogy earlier, but manufacturing is just one piece of the puzzle. Services make up roughly 2/3 of the entire U.S. economy. We are talking about restaurants, software companies, healthcare networks, finance.
And because it is the lion's share of the economy, the critical question for Monday is, will the services sector display the exact same Goldilocks cooldown that manufacturing did?
If it does, what happens?
If services moderate gracefully, if the prices paid by service providers drop, it permanently cements the interest rate relief narrative. It confirms the Fed has won the war.
And if they don't?
If the services index comes in red hot, if service-level inflation remains stubbornly high, it violently revives all those fears that inflation is structurally entrenched. A hot print on Monday could completely reverse the massive bond market rally we saw on Thursday.
That sets up Wednesday, July 8th, perfectly. We get the release of the FOMC meeting minutes from the central bank's June 16-17 session. The market is going to be reading the tea leaves, parsing every single adjective and comma from Chair Warsh's committee to gauge exactly how divided they are on executing a late summer rate pause.
However, there is a fascinating tactical insight buried in the strategy notes regarding these minutes.
Oh, what is it?
The institutional trading desks might actually view this release as instantly outdated.
Elaborate on that. Why would the Fed's own minutes be considered outdated?
Because of the timeline. That June 16th meeting occurred before the brutal 57K jobs miss we received on Thursday.
Ah, right.
When the committee sat down in mid-June, they were looking at a completely different, stronger economic picture. So even if the minutes reveal that policymakers were feeling incredibly hawkish and wanted to hike rates further due to sticky service inflation, the market knows those opinions are based on old data.
The underlying facts on the ground have drastically changed.
You might see the market completely ignore hawkish language in the minutes, writing it off as stale data, superseded by Thursday's labor shock.
That is exactly why you have to track the chronological flow of data, not just react to headlines in a vacuum.
Exactly.
Moving into Thursday and Friday, July 9th and 10th, we get initial jobless claims, existing home sales, and then we dip our toes into the early waters of Q2 earnings season. The marquee names reporting are PepsiCo, Progressive, and Delta Airlines.
And this isn't just about whether these specific stocks go up or down. These three companies serve as perfect proxies for the broader health of the U.S. consumer.
Absolutely. They are microcosms of consumer resilience. Let's look at PepsiCo first. Analysts are going to be laser-focused on a metric called their price pack architecture,
Which is really just a fancy corporate euphemism for shrinkflation.
shrinking the bag of chips while charging you the exact same amount, or subtly raising the price of a soda outpace inflation.
Precisely. Investors want to know, has the consumer finally reached their breaking point? Are they pushing back on high grocery prices by trading down to generic store brand labels?
If Pepsi's volume drops significantly, it signals the lower-income consumer is completely tapped out. What about Progressive Insurance? Why is an auto insurer a bellwether?
Progressive will give us the ultimate unfiltered read on auto insurance inflation, which has been one of the stickiest, most stubborn components of the entire consumer price index.
Car repair costs have skyrocketed.
They really have. If Progressive announces that they are still aggressively raising premiums on drivers just to maintain their underwriting margins in a competitive environment, it tells the Fed that core service inflation is still a severe, unresolved headache.
And finally, Delta Airlines on Friday. This feels like the ultimate test of summer consumer behavior.
Delta is the premier gauge for the experiences over things economy. We just discussed how jet fuel and crude oil costs are dropping due to clear maritime shipping lanes. Delta's core input costs are going down, which is great for their margins.
But the key question is demand.
Exactly. Are consumers who might be feeling nervous after seeing that awful 57K jobs report still willing to book premium summer travel? If Delta lowers their forward guidance despite having the tailwind of cheap fuel, it signals that the middle-class consumer is genuinely exhausted and pulling back on discretionary spending.
So, bringing all these complex threads together into a cohesive strategy, I have a broader question for you. I'm looking through these institutional notes, and major firms like JP Morgan are actively raising their year-end S&P 500 targets based on a broadening AI capex cycle.
Yes.
We know portfolio managers are using this quiet post-holiday week for tactical pre-positioning. If you are managing billions of dollars, where exactly is the smart money hiding out right now before the massive money center banks officially kick off earnings season in mid-July?
According to the institutional flow data and equity research teams, the smart money is quietly accumulating capital in two very distinct, almost contradictory areas.
Okay, what's the first?
First, they are flowing into cyclical value stocks, specifically the financials we discussed earlier, which benefit immensely and immediately from the uninverting yield curve. They are buying banks ahead of their earnings.
And the second area?
They are selectively, surgically buying the exact hardware tech stocks that were violently discounted during the Asian KOSPI panic.
Really? Leaning into the panic.
They are betting that the long-term half-trillion-dollar AI infrastructure build-out we talked about in South Korea is absolutely real. They're using the casino-like irrational volatility in Asia to buy premium U.S. and global semiconductor assets at a temporary localized discount.
Wow. Okay, let's wrap this up. We started today's deep dive trying to find the genuine signal in the noise of a truly historic, chaotic week.
And we found quite a bit.
We did. The core narrative that held true across equities, treasury bonds, and the commodity complex was that bad news is good news. A cooling, sputtering U.S. labor market provided the exact interest rate relief that blue-chip value stocks needed to hit absolute record highs. The factory engine slowed down, the friction eased, and the mechanics cheered.
But at the same exact time, the global technology sector navigated a massive casino-like stress test in Asia.
Yeah, it proved that while the foundation of the artificial intelligence boom is physically robust, backed by hundreds of billions in concrete and silicon, it remains financially highly volatile and vulnerable to liquidity shocks.
We're entering a phase of the market that demands extreme structural awareness from every investor. The physical infrastructure of our technological future, these massive AI chip hubs being built in places like South Korea, are currently trading with the wild, unpredictable volatility of meme stocks.
Yet, simultaneously, the U.S. software giants that will ultimately utilize those chips are being treated by the market as safe haven, bulletproof utility companies.
It's a massive, glaring disconnect.
It is a historic disconnect.
And so, as we move deeper into the third quarter, I want to leave you with a lingering question to ponder. We are living through a classic technological gold rush dynamic. But ask yourself this. When the picks and the shovels of the gold rush are priced like chips at a highly leveraged casino roulette table, can the miners truly build a stable, enduring empire?
That is a brilliant thought to chew on.
Keep a very close eye on how these global valuations reconcile over the next 3 months. Because the structural gap between Asian hardware volatility and U.S. software stability cannot last forever. One side of the ocean is going to have to reprice to match the reality of the other.
When the diagnostic tools are murky, you have to look at the structural foundation of the market itself. Thank you so much for joining us on this deep dive into the sources. We hope this extracted the signal from the noise and gave you the clarity and the mechanics you need for the week ahead. If you enjoyed Wall Street Weekly's market analysis, subscribe and leave a comment or a review wherever you listen to your podcasts, and follow us, Wall Street Weekly, on YouTube so you never miss a market update. We will be back next week with more weekly insights and analysis from Wall Street. Thank you for listening.